You know what you don't want to do? You don't want to be a 35-year-old stock trader who lives in a van down by the river. So let's talk about that. What's going on, guys, and welcome back to the Stock Advantage. My name is Darren, and if you love Chris Farley, go ahead and drop this a like on this video and comment your favorite Chris Farley skit or movie down below. That's a classic. Lost him too soon. But anyways, my name is Darren, and welcome back to the Stock Advantage. And today we're going to talk about some trading mistakes that a lot of people make that we need to try to avoid at all cost because they hinder us from making solid gains in the market. They deflate us from thinking that we can succeed at this, and a lot of other things. So without further ado, we're going to jump in and cover these big mistakes that we need to avoid for beginner traders and even experienced ones. You know, even the experienced people who trade struggle with some of these. So let's jump right into this. Number one, setting unrealistic expectations. As much as you want to turn $500 into $5,000, that's not really realistic. Sure, some people, you know, they put $500 on a crazy option play and they turn it into $5,000. But that's usually 1 in a million there. That's not the most common thing. And a lot of those people on the very next one will lose $5,000. So that's not realistic. What unrealistic expectations do is they lead you to trading too aggressively. You're thinking, oh, if I don't turn 500 into 5,000 this month, I'm a failure. So then you start being way too aggressive, not studying your trades, not understanding what's going on, and then you end up losing money. You get deflated, and then you just call it a day and say, I'm not cut out for it. Depending on your trading style, your percentage and your expectations are going to vary. So if you're a day trader, you may be trying to get 20 to 40% a month. Swing trader, the same. If you're looking at long-term investments, that may not be realistic. It all depends on your risk profile and what you're willing to risk. So if you're trying to turn 500 into 5,000, you know, it's going to take some risky trades to do it. But at the same time, you could take 500 and turn it into zero. So you've got to be careful there. Make sure that you go into it understanding what realistic expectations are. I mean, if you're a pretty solid trader and you make some pretty good moves, you can expect 10 to 20 to 30% a month. You know, 30%, it's not that repeatable. You'll have 30% months, but that's not necessarily a repeatable thing. So set some realistic expectations. Number two, and this is probably the biggest one, is trading without a plan. If you trade without a plan, then it's not going to work out well for you. And first off, that plan decides on what your trade type is. Are you a day trader? Are you a swing trader? Are you a long-term hold? Because those will tell you what your plan is. You need profit targets, so you need to have your entries and exits planned. So if you're a day trader, then your entry may be at this level, and then I want to make 1 or 2% on this trade. If you're a swing trader, you may say, hey, at 10%, I'm going to set my stop loss or my trailing stop, and I'm going to make sure I at least clear 10%, or maybe 10% is the time where you just check out of the market or out of that trade, and then you move on. That's all fine and dandy. Long-term hold, it may just be, hey, I'm going to add $100 to this stock every month, no matter what. So you need to have that plan in order to be successful. And the other piece of it is setting stop losses. All right, so part of your plan should be, you know, if you're getting into a stock long term, maybe your stop losses aren't that big of a deal. But if you're looking at a swing trade or a day trade, you need to have stop losses set in place. And just saying mentally at 5%, I'm going to cut it, usually doesn't get it, because when you get to that point, you're like, oh, I think it's going to come back up. And then before you know it, you're down 15, 20%. And you do not want to be that guy. So it's a lot better to take a small loss and admit, hey, maybe I got in a bad time on that play. It's a lot better to take that small loss and then go back and try to be more successful the next time. So stop losses are key in trading, especially if you're not able to be at the computer watching the stocks all the time. Number three, trading with emotions. Buying into the hype, having the FOMO, fear of missing out, bag holding, cutting too soon just because it's a bad day, right? Those are all emotional responses. You see a stock going up and it's already up 100%, and you're like, oh, I'm going to get the next 100%. You don't know what the company does. You don't even know what the company's name is. You just see a ticker. So then you buy into it, and then you don't realize that it's a pump and dump, and then you end up bag holding or something like that. Fear of missing out. You're thinking, I don't want to miss this. This could be the next Tesla. Well, if it's the next Tesla, do some research, and it's going to have another opportunity to go up. I mean, you're not going to miss the whole train. If it's Tesla, it's not going to be a pump and dump. It's gonna catch and it's gonna ride. So, if it's a long-term hold and it's having a bad day, the market's red. I've seen too many times people on a bad day, they'll sell their long-term positions because they're down a couple percent. And they're thinking, the market's going to crash. What is your plan, right? So all these are connected together. You need to be able to remove emotions from it, and that refers back to the plan. Don't think about it as I made a bad decision or whatever. You're like, what is my plan? If my plan is to stop loss at 5%, bam, right? So you take the emotion out of it by setting these stop losses, these profit targets, doing some due diligence on stocks, right? Don't just trade with emotions. Emotions are what gets you in trouble in the stock market. So do everything you can to take emotion out of it. And one of the things you might find out is you're trading with emotions because you're taking too big of positions, right? If you can't stand to lose $100 in 10 minutes, then maybe you shouldn't be trading with $1,000, right? Or whatever, whatever that may be. You need to only trade with position sizes that you're comfortable with. So for more stable companies, for more stable stocks, that may be a larger position size. But if you're trading with 80% of your account on a penny stock and you're sweating bullets and you're freaking out and you don't know what's happening and you're scared to death, chances are you should not have took that trade because your emotions are just wreaking havoc on you, and it's gonna handicap your ability to make good decisions. So take emotions out of it, whether that be through stop losses, setting your plan in place, as well as making sure your position sizes are manageable for your mental stability. Next up, number 4 is not being diversified. Too many times people put all their money into penny stocks, or they put all their money into tech, or all their money into EVs, like I've seen a lot of people do right now. You need to balance that risk, right? Among different stocks, among different sectors, different type of stocks, index funds, whatever that may be, ETFs, all that kind of stuff. You need to balance your portfolio, have it diversified, because that helps the red days not be so bad, right? When the whole EV sector's down, it's not as bad if it's only 10% of your portfolio than it is if it's 90, right? If it's 90% and it's down, then you're crying in the streets like, sad kitten, or whatever happens there. I don't know. I don't play with cats. But anyways, so make sure that you're diversified, and diversification is not having 20 different penny stocks in your portfolio. That's not a good idea. Just telling you. So make sure you're diversified, balance your risk, and your risk profile can be different, right? If you're 20 years old and you're just, you want to be a little more aggressive, hey, maybe you have 30% of risky stocks. I never recommend having a whole crazy amount, but depending on where you're at in life and what your goals are, you can have a different portfolio diversification. So there's not a specific set number of 80% this, 20% that, whatever. That's not a set amount. It's all based on what you're doing. But I will say that you do need to have some kind of diversification built into your portfolio. Number 5 is not doing due diligence. I will say that on every one of my YouTube videos. If you don't do the due diligence, it's not going to work out, because, I'll put it this way. If you're trading a ticker and you don't even know the company name, that's a problem. If you're trading a company and you don't know what they do, that's a problem. If you're trading a company and you don't realize that why they dropped 30% yesterday, and you think it's such a good deal, but you don't know why it dropped 30%, that's a problem. You need to do the due diligence, right? Research a stock, research a company, figure out what they do. If their stock dropped 20%, you need to go figure out why. Did they miss earnings? Did they file for some crazy, share offering? What happened? All that stuff helps you get information in order to successfully trade. Blindly listening to recommendations. Anytime I talk, I'm like, I'll give you my thoughts and my opinions, but you need to go do your own due diligence. Do your research on the company. Try to understand what they're doing. and what the opportunities are going forward. There's usually a reason why stocks fall. There's a reason why they go up. You need to understand that so you can understand what is a good trade to take in those situations. And then last one here is living in the past. I've got caught up in this a lot is thinking, man, I missed that trade. If I'd have bought Tesla at $30, I almost did it. Or I own Tesla at $100 a share, and now it's $4,000 after you take the split into account, or the split into account. But, living in the past, missed trades, selling early. Oh, I sold this one early. You selling late, right? Buying in at the peak. All those things are very good to learn from. So you take notes. I always take notes on my trades on what went well, what didn't, so that I can use that going forward. But what I don't do is I don't dwell on it, right? Use them as a fuel to understand and educate you going forward, but don't dwell on it. Don't think, oh, well, I'm just going to fail on this trade because last time I did this, or last time I did that. Don't think that way. Take those opportunities, turn them into a learning, and then move from there and be able to make successful trades. All right, guys, so that's pretty much it. I mean, there's a lot more mistakes that you can avoid, and this is for both beginners and experienced traders alike. So I just wanted to break down a few of these for you. If you want me to go into specifics on any of the ones I talked about today, go ahead and comment that down below. I would love to do a specific video on maybe how to do due diligence, or how I do it anyways. How to take emotions out of it, how to set stop losses, what kind of targets should you be looking for on certain types of trades. Put that down below. I would love to have that conversation and maybe do a video on those as well. If you do want to open a trading account, I recommend going to Webull. I've got a link down below. You deposit $100 and open the account. You get 2 free stocks. I get a free stock out of it, and we all go home happy. So anyways, links down below if you want to use that. I would appreciate the support on the channel. Again, don't forget to like the videos, subscribe, and click that notification bell so you can stay up to date with the stock advantage. So that's pretty much it for today, guys. Until next time, have a great day and God bless.